Hello everyone, I hope you guys are doing well and your studies are going in full swing. In today's video, we are going to do the complete revision for your all important CA Final AFM Advanced Capital Budgeting chapter with important questions. Now before we start this video, in this session we will be doing a quick revision of all the concepts and important questions from our Super 90 file which I have shared on the Telegram channel, the link for which is there in the description. Further, in case you want to access the full video of all the sums and a detailed discussion, I've uploaded that as well on YouTube separate. It's a 6-hour plus video covering everything in capital budgeting, each and every question and the concepts. So you can go into that if you want the detailed review and or if you want to cover just specific question. A lot of students have said that that is a long video. So in case you sit to revise, you want a quick revision. So I'll try to keep it quick and crisp. In less than an hour, we will try to complete the entire chapter with the questions. Perfect. So let us get started. Now, before we proceed, we'll go and do a very quick discussion about your CA intermediate concepts of capital budgeting. That is, if there's a long-term project, how do you decide whether you accept or reject the project? Various techniques were there. The best among them was the NPV, net present value technique, which is calculated as PVCI, present value of cash inflows, minus PVCO, present value of cash outflows. If NPV is positive, the decision rule is you should accept the project. If it is negative, you will reject the project. Further, another method was IRR, internal rate of return, which is the rate at which the PVCO equals the PVCI. You usually calculate this using the trial and error method. Again, if your internal rate of return is greater than the discount factor, that is cost of capital, we will accept the project. If your actual return on the project, IRR, is less than the cost of capital, then you will reject the project. A few other methods like profitability index were also there, which is PVCI divided by PVCO, and also payback period. That is the number of years it will take for a project to give back its cash flows. So a bit of traces of these methods are there in this chapter, but largely the advanced capital budgeting chapter focuses on the risk part. So when you're looking at various risk evaluation techniques, there can be certain conventional or also statistical techniques that you can be used for the purpose of evaluation. So we will go to each and every technique one by one. The first of that is the probability approach. Now, when I look at probability approach, this is quite important and practical from an exam perspective as well. Now, in your entire intermediate, what you have done is you have a project. Let's say in year 1 it has 100 cash flow, year 2 200 cash flow, year 3 300 cash flow, and something similar to that. Now the problem is, at year 1, who has told you with certainty that you have received 100 rupees of cash flows? Well, there's no certainty. Well, in all likelihood, there would be a range of cash flows, like the cash flow can be 50, which has, let's say, a 1/3 chance, or it can be 100, which has a 1/3 chance. It can be 150, which also has a 1/3 chance. And hence, if you sit and find the average, probably the average may come to around, let us say, 100. And as a result, you might have taken 100 over. However, there is a possibility that there can be a deviation in the cash flows, and the bigger the deviation, more the risk, lesser the deviation, lesser would be the risk. So what do you do in the probability approach? Rather than taking just a single number, we will have a range of cash flows, and you will try to find the probability based weighted average cash flow. This is called as the expected cash flow. Now, how do you calculate expected cash flow? It is probability based weighted average. So for example, if your cash flows were, for example, 10, 20 and 30, and the probability was 0.2, 0.5 and 0.3, for example, then your expected cash flow would be, for example, 10 into 0.2, that is 2, plus 20 into 0.5, that is 10, plus 30 into 0.3, that is 9, and hence, I mean, if my calculation is correct, your expected cash flow will be 21. This will be, let's say, cash flow for year 1. Similarly, there will be a cash flow for year 2. Similarly, there will be a cash flow for year 3. So when you calculate your expected NPV, that is based on expected, that is weighted average cash flows. So your weighted average cash flows for each of the years will be calculated. So that will give you your expected NPV. Expected NPV will be the present value of expected cash inflows in each of the years minus present value of cash outflow. Now, this expected NPV carries some risk because the cash flows can deviate, and hence you will try to calculate the standard deviation of these cash flows in each of the years. Like for example, if I were to look at the first year, let's say this project has 3 years, and in each of these years, these were the given cash flows, and 21 was the expected cash flow. Now, if I want to calculate the standard deviation, Let's say for year 1, I will say that, well, this will be calculated as summation of x minus x bar the whole squared divided by n. If there were, let us say, number of observation, if there's a probability, then you multiply it by p. So over here this is 10, 20 and 30. Over here the average is, for example, 21. So you will take 0.2, 0.5, 0.3 into, for example, 10 minus 21 the whole squared, 20 minus 21 the whole squared, and 30 minus 21 the whole squared. And whatever you do, I mean, you can just do the workings and you will get the final answer. So let us say you do this calculation and you get this number as 49. This will be the variance of the cash flows, and if you want to do the standard deviation, you take the square root of 49, which comes to, let's say, 7. Now this may be different. I'm just considering that these are your cash flows. So this is your standard deviation. Now remember, this is the deviation of cash flow in year 1. Similarly, year 2 also has maybe a different set of cash flows or similar set of cash flows. Then there is a possibility of another 7 of deviation possible in year 2, and let's say in year 3 another 7 of deviation possible in year 3. So what one needs to remember is, over here, like there is a portfolio where there can be multiple securities, in a similar way there can be a project where there can be multiple years. Now in each of the years there will be a separate standard deviation of, let's say, 7 in the first year, 7 in the second year, 7 in the third year, as the case may be. Now, like in a portfolio, you can calculate portfolio standard deviation. In a similar way, over here, you want to calculate the standard deviation of the project. Like portfolio standard deviation will consider the standard deviation of all the securities. Similarly, the standard deviation of the project will also consider the standard deviation of all the years. Like 7 is in the first year, maybe 9 in the second year, maybe 12 in the third year, depending on the data series, but it will consider, or it can be 7 in each of the years, but it will consider the standard deviation of the cash flow for each of the years. Now the question is, over here, how will you calculate it? Well, 7 of deviation in the first year is equal to how much today? So you'll have to find the present value. 7 of deviation in the second year is equal to how much today? So again, you'll have to find the present value, and so on. So if you want to find the standard deviation of NPV is in today's terms, then these cash flows whose standard deviations you have calculated also have to come in today's terms, and as a result you will find the present value of each of these standard deviation of cash flows. Now the problem is, when you look at the formula for portfolio risk or standard deviation NPV, we need to figure out whether year 1 and year 2's cash flows are related. Like in a portfolio, you need to find a correlation between security 1 and security 2. Here you want to find a correlation between, let's say, year 1 and year 2. For example, if there is no correlation, this is called as independent cash flows. This means correlation is 0, or it is dependent cash flows where there is full correlation. Institute just takes one of these two views, in which case the correlation coefficient is 1. So if your correlation coefficient is 1, that is in case of dependent cash flows, this formula that you will do will ultimately be the same as a squared plus b squared plus 2ab, that is a plus b the whole squared, and hence your standard deviation NPV will come to this number. Now this might sound to be a little complex in case your portfolio concepts are not very clear. So when you look at the formula of a plus b the whole squared, it is actually a squared plus b squared plus 2ab. Now a can be, let's say, the first year standard deviation, b can be the second year standard deviation, and 2 into a into b. Now if year 1 and 2 are correlated, you multiply this by correlation coefficient, that is 1, and hence this will ultimately be a squared plus b squared plus 2ab only, and hence this will be ultimately a plus b the whole squared, and if you square root this will be a plus b. Sir, what is a? Well, this is the present value of the first year's cash flows. What is b? Present value of the second year's cash flows. What is c? Present value of the third year's cash flows, and so on. So this is directly done. You are just adding the present value of each year's standard deviation of cash flows, and that will give you the standard deviation of NPV for a dependent cash flow. However, if you look at an independent cash flow, in case of an independent cash flow, the correlation coefficient number over here will actually be 0, because there is no correlation between the first and the second year, in which case this term will be restricted to a squared plus b squared. Well, by the way, 2ab term will ultimately become 0 because you are multiplying it by 0, and hence this will be a squared plus b squared. Well, if I want to find the standard deviation, I'll have to square root this, in which case this is a squared plus b squared plus c squared, so on. Institute sometimes calls this as the Hiller's model as well. So in case you see a question which mentions calculate the standard deviation of NPV using the Hiller's model, you can very well use this as well. So long story short, if you want to find the standard deviation of NPV, you can find the standard deviation of each year's cash flow. If these standard deviations these cash flows are dependent, then your standard deviation of NPV will be the present value of standard deviation of cash flow for year 1 plus the present value of standard deviation of cash flow for year 2 plus the present value of standard deviation of cash flow for year 3. However, if they are independent, then it is like a squared plus b squared plus c squared, and then you will square root it, because the correlation between each of these years is actually 0. So this is one of the way in which you calculate the standard deviation of NPV. Other more let's say basic way would be, in case there is a range of NPVs, like there was a range of cash flows given, in a similar way, if there were 10 different NPVs which are possible are given, then if you find the actual standard deviation in those NPVs, that will also give you the standard deviation of the entire project. Now we'll do this with numbers, will give you a better understanding, but first let me just cover all the concepts at one stage, and then we'll go to the questions. So over here, or we can review the questions as well. Let's say we review a question on this, maybe that will make it a little more easier to follow. So over here there is a question, you can just pause and you can just glance through the question. Okay, once you're done, you have following are the estimates of the net cash flows and probabilities for this project. So you have the initial investments, each year cash flows are given, and salvage value is given. The required rate of return on the project is 10%. The question asks you to find the expected NPV on the project. Now, if I want to find the expected NPV over here, how will I do this? Well, for the expected NPV calculation, let us say, if I go to this similar question, I will find the present value of cash outflows. Let us say, your initial investment present value of the cash flows, 4 lakh at all possibilities, and hence your cash outflow, for example, is 4 lakhs. Later, I will try to find the expected cash flow, like it can be 1 lakh, it can be 1 lakh 10, it can be 1 lakh 20 with different probabilities. So I'll find the probability based weighted average expected cash flow, which will come to, let's say, 1 lakh 9,000. Now, this is a project also having a salvage value. So in year 1, 2 and 3, 1, 2, 3, 4, 5, 1 lakh 9,000 is your cash flow. Similarly, there's some salvage value, which is a possibility of 20, 50 and 60. Everything you want to find expected NPV, you do this based on expected cash flows, and as a result you find the expected salvage value, again as a probability based weighted average, which will come to around 43,000. Now once this is done, we will try to find NPV in the usual manner, that is PVCI, that is 1,09,000 into the present value annuity factor at the rate of 10%, let's say that is a discount rate for 5 years, which is 4,13,000 plus salvage is in the 5th year, so 43,000 into the salvage value, that is around 26,000. So if you want to find the expected NPV, this is your present value of cash inflow, 4,13,000 plus 26,000 minus the cash outflow, 4 lakhs, and hence 39,895 will be your expected NPV. So over here you have taken the expected cash flows. Second, what is the best case and the worst case NPV? Now there are 3 cases, 1, 2 and 3. The best case would be the case where you have the highest cash inflows, that is the 3rd case, and the worst case would be where you have the lowest cash inflows, that is in the 1st case. So for the worst case NPV, you will take the worst cash flows. For the best case NPV, you will take the best cash flows and try to do the working. So over here, if I look at the best case NPV, my best cash flows are 1,20,000 for 5 years, salvage value is 60,000 in the 5th year. For the worst case, 1 lakh for 5 years and 20,000 in the 5th year. Having said that, you will find 92,000 for the best case and a negative 8,502, that is a loss for the worst case. Now there is only one more case remaining. If you want to do, you can do the working for that separately, but as of now, if only point 1 and 2 are asked, this is not separately required. So you have found the average NPV, you have also found the best possible NPV, which is 95% and something, worst possible NPV as well. The probability of occurrence of the worst case, if the cash flows are perfectly dependent over time or they are independent over time. Now this is interesting. Now if the cash flows are dependent over time, then once the first year is done, the second, third, fourth year are dependent on the first year. So if first year is bad, the second year is necessarily going to be bad. Sir, but what is the possibility of the first year going bad? Well, it is 0.3. There's a 30% chance that the first year goes bad. But if the first year goes bad, the second year, 100% chance, because it is dependent cash flow, is going to go bad. So is the case with the third year, with the fourth year, with the fifth year. And as a result, if I do this calculation, I will see 0.3. This is a 30% chance of the worst case being reached. However, if the cash flows were independent, then each of the years are independent. So will the first year go bad? Well, there's a 30% chance. But merely because the first year goes bad does not mean the second year also goes bad. So in the second year, for it going bad, for the worst case to achieve, the first year should go bad, and the second year, and the third year, and the fourth year, and the fifth year. And as a result, you will multiply a fresh 0.3 in each of the years. When you look at the dependent cash flow setup, if the first year goes bad, the second year will necessarily go bad, third, fourth, fifth year will also necessarily go bad. But in case of an independent cash flow, that may not be the case, and hence this number will be 0.00, I think 243. So this is a much lower probability. Remember, even if this was a best case, the probability of the best case being reached would have been 0.2 for a dependent cash flow, because if first year is good, every other year will necessarily be good. The probability of best case will be also lower for an independent cash flow, 0.2 into 0.2 into 0.2 into 0.2, let's say 5 times. Okay. Fourth language is a little interesting. They say standard deviation and coefficient of variation. Assuming there are only 3 streams of cash flows. Remember, only 3 streams of cash flows are only possible if this is a dependent cash flow setup. If it's an independent cash flow setup, then it is possible in the first year you have 1 lakh, second year you have 1 lakh 10, third year again you have 1 lakh, fourth year you have 1 lakh 20. So that is one possibility. There can be countless such possibilities in case of an independent cash flow, but in case of a dependent cash flow, there will be only 3 streams, which is represented as above, and hence this line in the question, that considering only 3 streams of cash flows, shows that this question is a dependent cash flow question, which are represented by each column of the table with the given probabilities. Now, Institute has solved this in a smart way. What they have done is, well, if there are only 3 streams of cash flows, then there is 1 NPV possible. This is in the worst case. Second NPV possible in the best case. The third NPV, if I somehow find, well, that is very easy, taking 1,10,000 and 50,000, I'll find the third NPV. There are only 3 NPVs possible. So you find the 3 NPVs and then find the standard deviation of those NPVs, you will get the answer. Something similar to this. So over here, we have done this probably in a slightly in 2 alternative methods. So let's say if you look at an alternative, you will find NPV of the worst case as 8502, best case we have done is 92,150, and if you take the middle case, you will get around 47,950. Well, if I find weighted average, expected NPV is around 39,000 and something, and I find the deviation, that is x minus 39,000, the whole squared into p, and you will get the standard deviation of NPV at approximately 35,800. This is a shortcut where you have 3 possibilities, you exactly find the 3 NPVs and find the deviation in that, like you do in portfolio. Another way would be to calculate it by the formula that we studied of dependent cash flows, where you find the standard deviation of cash flow in each year. So this is another alternative that I have done additional. This will not be there in the institute's material. So you find in each of the years, the average cash flow is 1,09,000. If you compare and find the deviation, that deviation comes to around 7,000 in year 1, also year 2, 3, 4, 5, in each of the years there is a possibility of a deviation of 7,000. Further, for salvage there is a possibility of deviation of 20, 50, 60, so there is a possibility of deviation of around 15,524. I am not going to do the exact calculation, you can pause and calculate if you want to do that from your screen. Now if I apply the formula that we studied over here, which is for dependent cash flows, we take 7,000, which is the standard deviation for the first year, into discount factor for the first year, plus another 7,000 for the second year into discount factor for the second year, and so on for each of the years, which means you can even take the PVF. And finally for the salvage value, 15,000 into the present value factor for the 5th year. If you do this properly, you will get the standard deviation as you can see over here on your screen, at around 36,174. Now there is a hardly 200-300 rupees difference, which is due to rounding off of such big numbers, which is very much acceptable. So over here you will find your standard deviation of the NPV in either of the two methods which you feel comfortable. But you have to find the standard deviation and also the coefficient of variation. How do you calculate coefficient of variation? Well, you will calculate it as a standard deviation divided by the expected NPV. So your standard deviation is approximately 36,000 and your expected NPV is around 39,000. This is around 0.91:1 of coefficient of variation, that is standard deviation divided by the average. Next you have coefficient of variation on its average project is in the range of 0.95 to 1. Remember, higher the coefficient, higher the risk, lower the coefficient of variation, lower the risk. If the coefficient of variation is found to be less risky than average, 100 basis points, that is 1%, is deducted from the company's cost of capital. Should the project be accepted? Well, over here, my project has a 0.91 coefficient of variation, where the average project has 0.95 to 1, and hence my project is less risky, which means my required rate of return will be adjusted, risk adjusted, lower risk in the project, so my discount rate will be adjusted to 9%, and the last case you will take the expected cash flow. Decision making is based on expected cash flows. So 1,09,000 discounted the rate of 9%, expected salvage value discounted at 9%, and you find a positive NPV, and hence the project should be accepted. So over here this is a fairly detailed working where you can have practice on the expected NPV calculations, probabilities, coefficient of variations. So it's a fairly good question. Okay, if this question had independent cash flows, then what you would do is you will find the standard deviation of cash flows each year, and then you will just kind of square each of these numbers and square root it. So that will give you a different answer in case of an independent cash flow setup. Okay, so this is probability approach, one of the most detailed and important approaches over here. Okay, another thing over here is you have something called as risk adjusted discount rate and certainty equivalent. Like one of the subparts that we did is similar to risk adjusted discount rate. If a project has a higher risk discounted by a higher discount rate, higher the risk, higher will be the required rate of return. The project has a lower risk, you adjust it by a lower risk adjusted discount rate. There are various techniques like standard deviation, coefficient of variation, which you can calculate and find the risk which is there in the project and the risk which is there in the project, and considering that risk you can try to find the required discount rate. Second approach, risk adjusted discount rate, is used quite frequently in practice. The second approach over here is a certainty equivalent approach. When you look at certainty equivalent, well, we say that usually we try to predict cash flows. However, that is based on your expectation of the best case, worst case, average case, etc. happening. Now there is a possibility that I expect that if I take a batch, I might get 100 students, I might get 150 students, I might get 200 students. I'm making expectations of the students that I will have in case I take a batch. So there is a range of possibilities. However, if someone were to ask you, how much are you quite certain? Bare minimum kitne students aayenge? We are saying that chalo 50 will come bare minimum, for example, in which case that is your certain cash flows. So there will be a certainty equivalent factor which is there, and you will multiply your expected cash flows with the certainty equivalent factor. Now, certainty equivalent factor has to be kind of given to you in the question. You can't calculate it based on the expectations of certainty / uncertainty. So over here, when you look at certainty equivalent approach, there will be a certainty equivalent factor which is given. You will multiply that to the expected cash flows to get the certain cash flows. And for finding the NPV, you will find the present value of the certain cash flows. Now, because you have removed the uncertainty and you are just having the certain cash flows, because you have removed the uncertainty, these cash flows are not having as much risk. So the appropriate discounting factor for a certainty equivalent question should ideally be your risk-free rate, because there is very limited risk. Now, if I want to apply this in a question, another question if you kind of touch upon is question 2, where you are going to touch upon the risk-adjusted discount rate as well as the certainty equivalent factor. A company is considering 2 projects, M and N, requires 8,50,000 and 8,25,000 of cash outflows. The certainty equivalent approach is used for incorporating risk in capital budgeting decisions, and the current yield on government bonds is 6%. So this is like the risk-free rate and can be used as the risk-free rate. The expected net cash flows and the certainty equivalents are, so 4,50,000 and 0.8, 5 lakhs and 0.7, 5 lakhs and 0.5. Remember, this is not probability, this is your certainty, which means if you do 4 lakh 50 into 0.8, probably I'm not sure, this comes to 3 lakh 60. We are saying that 3 lakh 60 you're certainly going to receive. Over and above that 90 is uncertain. 5 lakh into 0.7, 3 lakh 50 you are certainly going to receive. And maybe 2 lakh 50 you are going to certainly receive. So these are your certain cash flows, and you will find the present value at 6% to find the PV of certain cash inflows. Whatever that PV comes, minus 8 lakh 50, and that will give you the NPV for project M. Similarly, you will do the working for project N. So this is 8 lakh 60 minus 8 lakh 50, that is 8 lakh 10. You will do a similar working for N, where you will multiply, let's say 4 lakh 5 you will get, then 3 lakh 60, 3 lakh 50, and find the NPV, which is 1 lakh 71. Higher the NPV you will select, and that's about it. So it's quite scoring if you know the basic calculations and meaning. Which project should be accepted? N. If the risk adjusted discounted method is used, then which project will be appraised by a higher rate? Now this is interesting. If the risk adjusted discounted is used, which means higher the risk, higher will be the discounted, lower the risk, lower will be the discounted. Typically, you do that by calculating the coefficient of variation or standard deviation, which is probably not possible over here, because within year 1, I don't know what are the possibilities. Within year 2, I don't know. I just know the average possibility. So what Institute has done over here is, they have taken the total of the certain equivalent factors. Like for example, the total over here is 2, whereas the total over here is, I think, what, 8 and 9 could be 17. I think this is 2.4 if I'm not wrong. Okay, so project N seems to have higher certainty. Higher certainty means it will have a lower discount rate, whereas M appears to have a lower certainty, and lower certainty means a higher rate. So over here the question is asking you which project should be appraised at a higher rate. We will say M. Why? Because it has a lower certainty factor. Lower certainty means higher uncertainty, and hence project M should be appraised at a relatively higher rate. Okay, so this is your discussion regarding risk adjusted discount rate and certainty equivalent questions. Next, you go to sensitivity analysis. Now, this is something that Institute likes to ask. Two of the most common things over here is, what do you mean by sensitivity? First, sensitivity means that in a project there are various variables, like selling price per unit can change, variable cost per unit can change, fixed cost, discount rate, project life, cost of capital. These factors can change. Now, the thing of sensitivity analysis is, you can find the expected NPV, but that expected NPV can change. So if one particular factor changes, let's say just the selling price changes, then what will be the impact on the expected NPV? That shows the sensitivity of the selling price to the expected NPV. Or if let's say fixed cost changes, or a project initial cost changes, then what will be the impact of that change on the NPV? Well, that will be the sensitivity analysis. The important thing in sensitivity analysis is that one factor changes, all else remaining constant. So over here, there will be a change in one factor. Now, there are two alternatives that you will see across the Institute material which they have solved. In one of the alternatives, which is consistent across all questions, is they say that what should be the percentage change, for example, in a particular factor, let's say selling price, such that the NPV becomes 0. Again, what will be the percentage change in one of the factors such that the NPV becomes 0? So most commonly what you will do is, let the selling price per unit be X, and at that X selling price per unit, you will formulate the NPV equation where NPV is equal to 0. So you will find X. So let us say your original selling price was 50. Now at X, let's say 45 ka selling price, your NPV becomes 0, which means you can say that if the selling price falls from 50 to 45, that is a 10% fall in selling price, and your NPV will become 0. So you are trying to say that how far should a particular unit change for my NPV to become 0. Or let's say you do a similar working for variable cost or fixed cost, where you say let the variable cost be X, let the fixed cost be X, and accordingly find the revised variable cost compared with the original variable cost, and see how much percentage will there be a change to bring the NPV to a 0 value. This is one way in which you do. This is usually possible where the selling price in each of the years is same, or the variable cost is same, or fixed cost is same. In some of the questions, what will happen is, maybe the cost in each of the years are different, or if you have to find the sensitivity to output in each of the years are different. In which case what you will typically do is you will find that what is the present value of these, let's say, total running cost or variable cost. You will find the existing present value. Let's say it comes to 5,000. Your current NPV is, for example, 3,000. So you are saying that if my variable cost increases in present value terms by 3,000, because my NPV is 3,000, so abhi currently it is 5. If it increases by 3,000, that is 5 plus 3, 8,000 agar ho jata hai, that means my NPV will become 0. So a change of 3,000 on the base of 5,000, that will be, for example, a 60% change to be done in present value terms in order to make your NPV 0. This is usually done only in special cases where the values are different in each year. So first method to calculate sensitivity is how much should be the percentage change in a particular factor to bring your NPV to a 0 balance. Another possibility which Institute has used in a lot of questions is how much should be the percentage change in NPV for a, let's say, 10% adverse change in any factor. Now that can be 10, it can be 5, it can be 2.5. Question has to tell you. Like for example, if the selling price changes by 10%, then how much will be the NPV? NPV change, for example, is 50%. So we are trying to say that for a 10% change in selling price, there's a 50% change in NPV. Or if there's a 10% change in variable cost, there's a 30% change in NPV. So this is another method. One alternative is let the factor be rupees X in order to get nil NPV. We will use the NPV equation to find the revised value of the factor where NPV is 0. Percentage change to get a nil NPV is the sensitivity. So this is what you will do in the exam if nothing is given. Assume an adverse change, let's say 10%. Some questions will tell you, okay, let's take an adverse change of 10%. Find the revised NPV and the percentage change is the sensitivity. IC has solved most questions using alternative 1 and hence we will do that unless you are specifically told to solve using alternative 2. A special case is if running cost or saving per annum is not constant. Then in such case sensitivity can be calculated as a reduction in NPV to make it 0. So if your currently NPV is 3,000, to make it 0, NPV should fall by 3,000. Divided by the cumulative present value of the relevant discounting factor. So let's say running cost ka present value is 5,000. We are saying that, well, this 5,000 has to change by 3,000 in order to get a 0 NPV. So that is a method which is usually taken. Okay. Like sensitivity analysis changes one factor at a time. So it is trying to show you the impact that each factor has on the NPV. Scenario analysis builds up a complete scenario. It says that why is it necessary that only one factor has to change at a time? There can be multiple factors that can change at one point, and hence you build different scenarios, the best case, worst case, etc., and find NPVs at each of these scenarios. Now, in the business valuation chapter, they have given a name to this method as first Chicago method, where they will find the NPV in the first scenario. Like in the question we discussed, NPV under the best case scenario was 92,000. In the average scenario was, let's say, 47,000. In the worst scenario is a negative 8,500. You assign probabilities to each of these scenarios, and based on that, find your expected NPV. That is scenario analysis, where multiple factors change at one point and not just a single factor. That is scenario analysis. So over here we'll try to review an interesting question which is there. Let us review this. So the easygoing company is considering a new project with initial investment for a product survival. It's estimated that the IRR of the project is 16%. Now before you go to this question, a few important rules of capital budgeting you should be aware of. The first rule over here is at IRR, PVCO equals to PVCI. That means at IRR, NPV will be 0. PVCO equals to PVCI, so NPV will be 0. Further, if just NPV is asked, then NPV is to be calculated using the cost of capital as a discount factor, not the IRR. Okay, so there is a company which has an IRR of 16%, estimated life of 5 years. Finance manager has studied the project with sensitivity analysis and informed fixed cost sensitivity to be 7.8416%. and cost of capital sensitivity to be 60%. So this is a question where sensitivity is directly given to you. So it's a back calculation type of a question. Other information, price to volume ratio is 70%, that is contribution divided by sales is 70%, variable cost is 60, and annual cash flow is 57,500. How will you calculate annual cash flow? Total sales minus variable cost minus fixed cost will give you the annual cash flow if there is no tax. Ignore depreciation and investment on investment and impact of taxation. So there's no depreciation, no tax as well. Now initial investment of the project, how do I calculate? Well, initial investment, that is PVCO. I will try to find PVCI, that is 57,500 into IRR is 16%. So into the present value factor at the rate of 16% for 5 years will be 3.274. If I multiply, this will probably come to around 1,88,255. Now this is actually my present value of cash inflows. However, at IRR, PVCI will equal to PVCO, and hence 1,88,255 will also be my initial investment or cash outflow. Second, NPV of the project. Now NPV of the project, one can say PVCI minus PVCO, but that PVCI has to be calculated using cost of capital. I don't have the cost of capital, but I've been told that the cost of capital sensitivity is 60%, which means if my existing cost of capital is X, if this increases by 60%, that is, it becomes 1.6x, then my NPV will become 0. How do you understand sensitivity? The change that has to be happening in a particular factor to get it to a 0 NPV. So if my existing cost of capital is X, if it increases by 60%, why increases? Because if cost of capital increases, that is when NPV will fall. If it increases by 60% and hence it becomes 1.6x, that is when my NPV becomes 0. But well, I know that NPV is 0 at IRR, which means I can say that 1.6x will be 16%, then x is equal to how much? Well, x is equal to 10%. You can do it alternatively as well, where you say that, for example, 16 is the rate at which NPV is 0 minus x upon x. So this is 16, or we can say 0.16 equals to 60%, that is 0.6. This is your sensitivity. In which case, if you calculate x, you will ideally get x as 10%. Now once you get x as 10%, your PVCI will be 57,500 into 3.791, that is 2,17,982.5 minus initially you have invested 1,88,255, and hence whatever is left will be your NPV, 29,727.5. Okay, next you go to annual fixed cost. Now annual fixed cost, there is a fixed cost sensitivity which is given to you as 7.8416%. Fixed cost is something which is annual, which means I don't know what my fixed cost is. So let's say my annual fixed cost is X. Now the thing is, if this X changes by 7.8416%, now that is for the first year, second year, third year, fourth year, fifth year, it is there in each of these. If this changes by that is, it increases by 7.8416%, then my NPV will be wiped off. It will become 0. But in today's terms, what is my NPV? 29,727.5. So I will say that, well, if my annual fixed cost is X, and if this changes by 7.8416%, now this is a change per annum in 1 year, but there are 5 such years, so into PVAF, that is 3.791. So this change in today's value terms will equal to the change to bring NPV to a 0 balance, and as a result that NPV is 29,727.5. If you now sit and solve for this, you will probably get X at around 1 lakh rupees. So your annual cash flow will come to around 1 lakh rupees. That is your annual fixed cost. You can sit and calculate for this. Acha, then is estimated annual unit of sales. Ab unit of sales ke liye there is contribution. Your PV ratio is 70%, which means your variable cost is 30%. So if 30% is equal to 60, then 100 is equal to how much? If you sit and calculate, your selling price will come to, I think, 200. Your variable cost is given to you as 60, which means your contribution will be around 140. Now this is contribution per unit. How many units are there? Well, I don't know. Let the number of units be X. In which case you will say that 140X, this is your 140 is a contribution per unit, into X, that is number of units, minus the fixed cost. This is 1 lakh. This will give you the annual cash flow, but well, the annual cash flow is 57,500. It's a fairly good question. So basically 1,57,500 divided by 140 will come to around 1125. X will be around 1125 units. Your annual units must be 1125. And last is break even. Acha, what do you mean by break even? The number of units that you should make to cover the fixed cost? Well, 1 unit will earn 140 rupees. So how many units do you need? 1 lakh, which is your annual fixed cost, divided by 140 per units, you need around 714.285 units. Now this is something which is, I would say, quite an interesting question. There are a few other questions on sensitivity, but that involves a lot of manual calculation, and hence if you see the institute's main exams, there have not been full-fledged sensitivity calculation questions because it is very calculative, but this is interesting, has to apply a lot of capital budgeting concepts to crack this question. Okay, next you go to now scenario analysis is very similar to that question number 1, where you have the best case, worst case, average case scenario. You find the 3 NPVs, and if an expected NPV was to be taken, then probability for each of these scenarios, and you find that. So in scenario analysis, multiple factors change at a point. In sensitivity analysis, only one factor will change at a particular point in time. Now the next concept over here, which is also used in the AFM, International Financial Management chapter, is on inflation and capital budgeting. Now the rule over here is inflation adjusted cash flows should be discounted at inflation adjusted rate. We call this as nominal. That is, if cash flows include the effect of inflation, also called as nominal cash flows, then you discount it at the nominal rate, which should also include the effect of inflation. Or if the cash flows are real, that is, they don't include the effect of inflation, then your discount factor should also be real, should not be including the effect of inflation. So the rule over here is nominal cash flows should be discounted at nominal rate, real cash flows should be discounted at real rate. In the exam, you can do whatever is comfortable, though I personally prefer that if nothing is given, you convert the cash flows into nominal, including the effect of inflation, and then discount rate also including the effect of inflation, and then solve. It is generally a better approach in practice. But though real cash flows discounted at real rate will also work. Now there was some inconsistency in the institute's material over here within capital budgeting and also between capital budgeting and IFM. Like, if nothing is given, cost of capital is what? Well, in IFM they have always taken that if nothing is given, cost of capital is your nominal cost of capital. It includes the effect of inflation, because in the market risk-free rate and everything will be higher in India if inflation is higher. So your nominal cost of equity, cost of debt are already including the effect of inflation. So ideally, if nothing is in, cost of capital should include the effect of inflation. But in the advanced capital budgeting chapter, the sums that you see, they mention cost of capital, and most places they mention including inflation premium, including. So in this chapter, if nothing is there, they have taken that means it is real, does not include inflation. So that is an inconsistency as we speak between the chapter of advanced capital budgeting and international financial management. Maybe two different people in the board of studies have made two chapters, and hence there is a difference. They've tried to correct some things, but still that inconsistency remains. In my opinion, ideally your cost of capital, if it is only given, they have not told you it includes inflation, they have not told you it excludes inflation, then it should be assuming nominal. That is my understanding, but my understanding matters less. What the institute does matters more, which means unless the institute corrects, if advanced capital budgeting wala question aata hai, then we will take cost of capital. If it is given including inflation, then including inflation, excluding inflation, then excluding inflation. If nothing is given, we will assume this is the real rate for advanced capital budgeting type of questions. But for IFM, International Financial Management questions, if nothing is given, then the cost of capital is taken to be including inflation. So nominal. So that is an inconsistency, but I can't do much. You'll have to remember that. Okay. But let us assume if it comes in the exam, mostly it will go through a good screening process, and they will tell you that whether this cost of capital includes or excludes inflation. So conceptually, if I want to calculate the nominal rate from a given real rate, how will I do that? I will say that 1 rupee of principal plus a nominal rate, let's say I don't know what that is, let's say n, equals 1 plus the real rate. Let's say I'm expecting on 1 rupee, I expect 10% real return, and on that 1 rupee I also expect a 5% compensation for inflation. So the way you calculate is 1.1 into 1.05, which means this is 1.155 will be 1 plus nominal. So basically after 1 year I need compensation for time, that is inflation. I also need compensation for my real return, and hence if I get 15.5% return, that will be compensating me for both, and hence my nominal rate can be calculated as 1 plus inflation into 1 plus real rate. The rule over here is you discount nominal cash flows at the nominal rate, or you discount real cash flows at the real rate. Okay. So over here, if you were to touch upon a particular question, For inflation, this is probably one of the best questions when it comes to inflation and capital budgeting. X requires 8 lakhs for a unit. So this is your PVCO. This is investment. Useful life of the project is 4 years. So technically 2 lakhs is a depreciation in nature, but depreciation is only relevant if there is a tax rate given. Otherwise, depreciation is non-cash and hence does not have any other impact. Salvage value is nil. Depreciation charge is 2 lakhs. Expected revenues and cost excluding depreciation, ignoring inflation, are given, which means these are real cash flows. Revenues, cost, etc. Tax rate is given at 60%, which means depreciation is to be considered because depreciation will give you tax shield or tax savings. And cost of capital is 10%, clearly given including inflation premium, which means your cost of capital is nominal, but the cash flows are real. Okay, calculate NPV of the project if inflation rates for revenues and cost are as follows. So you have for each of the years different inflation rates. So there is no single common inflation rate, in which case what you will first do is you will convert the real cash flow into nominal, which means the revenues of 6 lakhs into a 10% inflation, which means your inflation adjusted revenue would be 6 lakh 60. Now 7 lakh real, if I want to find after 2 years, well, over 2 years, the inflation was 1.1 in the first year and the inflation in revenue was 9% in the second year, so into 1.09. So if I go to see 6 lakh real cash flows will be 6 lakh 60, inflation adjusted. Just 7 lakh in today's terms, 7 lakh will increase by 10% in the first year, but for second year plus 9%. So basically this is 8 lakh 39,300. Similarly, if I go to the third year, this is 8 lakhs increases 1.1 into 1.09 into 1.08, and similarly for the fourth year. So basically you will find nominal revenues. From that you will subtract cost. Achha, cost ke alag alag inflations. Same way you will find inflation adjusted cost numbers. Achha, but this is excluding depreciation. Remember, depreciation does not get impacted by inflation because I have invested 8 lakhs and hence on that 8 lakhs divided by 4, 2 lakhs is going to be my exact depreciation, not 2 lakhs plus inflation. So over here, if I want to calculate, and we can do it in multiple ways, if I want to calculate, just a second, this working, I will find the inflation adjusted revenue, nominal revenue, then I'll have nominal cost like we have done over here, and then I will subtract depreciation. This will give me PBT. From the PBT, I will subtract tax of 60%, that will leave me with the PAT of 49,600. But remember, for finding NPV, I don't need PAT, I need cash flow. Cash flow is PAT plus depreciation, and hence, if I want to calculate the cash flow, this is PAT plus depreciation for year 1, similarly for year 2, 3 and 4. Discount it at 10%. Sir, but 10% is inflation. Yes, my cash flows are also including inflation. My discount rate is also including inflation, and hence, my NPV will be around 1,06,968, discounting nominal cash flows at the nominal rate. Here you cannot take the real rate approach because there is no single inflation rate, there is multiple inflation rates, and hence that formula of 1 plus nominal is equal to 1 plus real into 1 plus inflation you cannot use because there is no single inflation rate, and hence this method is generally considered to be more acceptable, more popular for solving capital budgeting questions. Okay, so this is inflation and capital budgeting. A few other concepts over here will be on optimum replacement time. So usually what happens is, if you have a machine and you want to let's say you are like a Zomato, Swiggy, etc., and you are having various bikes, Zepto, you want to replace the bikes. Now usually the physical life of the bike may be 5 years, but you don't want to use it for 5 years. You might have heard about this concept of useful life. Now you want to retire it early, but when do I retire? What is the optimum time? Should I retire after 1 year, after 2 years, after 3 years, after 4 years, or run it for the entire 5 years? How will I decide that? So one of the best ways to do is to find something called as annualized cost, which means you will try to find the total cash outflow over the entire life. So let's say you are planning to run over 4 years, then initial investment plus you will have present value of your cash outflows, whatever is your cash outflows of repair, maintenance, etc. for all the 4 or 5 years, minus the salvage value at the end. So usually what happens is, the longer you use, the more will be the repair cost and lesser will be the salvage value. The shorter you use, the more will be the salvage value, lesser will be the repair cost, but then you will have to replace it again. So your initial investment will have to be done over and over again because you want to replace it. So you will find the present value of net cash outflows at each of the replacement cycles, 1 year, 2 year, 3 year, 4 years, etc. Now the problem over here is when you do this working, you cannot just compare and say, okay, whichever gives me the lowest cost you select, because they are having different lives, and if they have different lives, there's a concept of annualized cost that is divided by the PVAF to find the effective annualized cost. That means on a per annum basis, what is the cost which is incurred equally for running? The option which gives you the lowest will be the option that you will select. So in case of optimum replacement time for a new machine whose cash flows are likely to continue, replacement will be done by calculating annualized cost, that is PV of net cash outflows upon PVF. Now there can be certain sums where you are deciding just to replace the existing machine and in turn take a new machine, in which case the new machine is completely different, existing machine is different, in which case you will have to do the evaluation for the existing machine separately. But generally for optimum replacement time, if the type of machine being replaced is similar, in which case what you will do is you will calculate the equated annualized cost. The year where you get the lowest equated annualized cost is the option that you will select. Now if I review a question on this, I think question number 6, trouble-free solutions is an authorized service center for air conditioners. Complaints relating to matters of AC are attended by the service center. They employ a large number of mechanics, each of whom is provided with a motorbike. It's just a story, useless. Each mechanic travels 40,000 kilometers per annum. They decide to continue the present policy of always buying a new bike, but wonders whether replacing every 3 years is optimal or not. Story, gas. It is believing new models are entering on a yearly basis, wants to consider whether replacement in either 1 year or 2 years would be a better option than the present 3-year period. The fleet of bike is due for replacement shortly. That's fine. Okay, the purchase price of the model is 55,000. Resale at current prices is given, so these are salvage values, and the cost excluding depreciation. Remember, depreciation is relevant if tax rate is there. If it is not there, you can ignore it. So this is, let's say, total running cost of 33,000 in the first year, maybe 38,000 in the second year, and 46,000 in the third year. Opportunity cost of capital is 10%. You are required to find the optimum replacement time. Now we have not been given tax rate, and hence depreciation is to be ignored. So over here, if I were to replace it after 3 years, then my cost would be, for example, 33 discount at the rate of 10%. If I were to discount at the rate of 10%, this is 33,000 into 0.9091. Let's say this is around 30,000 in present value terms. 38 into 0.8264, maybe 31,000. 403, 46,000 into 0.7513. 34,560. So if I were to total all of this, maybe I get 95,963. So I'm trying to say that this is my total cash flow, cumulative 95,000 and something. Okay, now if I want to find that if I run it for 3 years, what I will have is the purchase cost of the bike plus 95,000 of cumulative cash outflows. And there is some resale value. The resale value is 9,000. So this is what? 9,000 into 0.7513. This is 6761. So this is 67 something. And hence there is a net cash outflow. If I go to see, I'll run it for 3 years. I'll get 95,000. I'll incur 95,000 of cost, get 6,700 of salvage value, and hence 89,000 effectively will be my cost. So 55,000 is the cost of the new bike, and another, let us say, 89,172 you are incurring. So this is 1,44,000, but this is for 3 years. So you divide by the PVF for 3 years and hence get 57,993. Similarly for 2 years, I am saying that I'll have to spend 55,000 plus 61,000 for running cost. Salvage is around 21,000. You find the present value, which comes to 16, and hence 44,000 will be your net cost. Divide by the PVF for 2 years and 57,083. Whichever option gives you the lowest, you see, which will be your optimum replacement time. So this is a clear question, and Institute has even asked you one of these questions, I think, in the May 24 exams. So there are a couple of other questions in the Institute's material. In our book, I think that is question 21 and 25. They are little inconsistent. 21 and 22, I don't remember, and 25, they're a little inconsistent in the way that they're not comparing it properly, but over here these types of questions they have done it properly, and hence if it comes in the exam, you can easily take the optimum replacement time and select whichever is lower. Okay, another question over here was on a traditional capital budgeting type of a question. So whether you repair a machine, upgrade it, or replace it altogether. So this is question number 5. So if you try to kind of review question number 5, a company has an old machine having a 0 book value which can be sold for 50,000. The company is thinking to choose from one of the two alternatives, either to incur 10 lakhs to upgrade the machine or to replace the old machine with the new costing 20 lakhs plus installation cost. So now when we go to see over here, there's an option, you are running an old machine, there's an option that you continue running the old machine, or you upgrade it by spending 10 lakh rupees, or you kind of discard the old machine and take a new machine by spending 20 lakhs plus 50, that is 20 lakh 50,000. The above proposals envisage useful life to be 5 years, average value to be nil. The expected, देखो क्या दिया हुआ है, after tax profits for the 3 alternatives are as under. So this is PAT given to you, but for your evaluation you need cash inflows, that is PAT plus depreciation. So this is after tax. So this is profit, not cash flow. This is profit. Profit is after depreciation, after tax, everything, but your cash flow will be PAT plus depreciation. Under 3 alternatives are, so you have these 3 machine alternatives, tax rate is 40%, but this is already PAT, it is after tax, so you don't need to do separate tax calculation. But this is also after depreciation, and hence you will have to add back depreciation. The company follows SLM of depreciation, cost of capital to be 15%, and you are being given discount factors. Advise the company which alternative to be adopted. Now the thing is, alternative 1 is continue with the existing machine. If you continue with the existing machine, you don't have to spend anything. Nothing at all. You will not even get the salvage value because you are continuing to use the existing machine. So what you will get is these cash flows. Achha, this old machine has a book value 0. If it has a book value 0, the existing depreciation will be 0 rupees, and hence these will be the cash flows. You discount it at the rate of 15%. There is no depreciation to be added back, and hence you will find the NPV. So the first alternative is continuing the existing machine. You have the same cash flows as given in the question. Present value of cash inflow is 19,07,540. There is no cash outflow because you are continuing with the new machine, no upgradation, no replacement, and that's it. That is your NPV. Now second case, you are upgrading, means you are spending 10 lakhs. This is assumed to be capital in nature, and hence on this 10 lakhs you will get a depreciation over the next 5 years, let us say of 2 lakhs in each year, and hence over here if I do the NPV working, my PVCO will be 10 lakhs, and when I calculate the PVCI, well, this is my cash inflow. No, this is PAT, and hence to this I will add back the depreciation of 2 lakhs in each of the years. 7 lakh 50, I think 2 lakhs here, 5 years, yes. So I will add back depreciation. So if I go to say PVCO 10 lakhs, add back 2 lakhs, 7 lakh 50, 7 lakh 90, 8 lakh 10, and so on, discount it, get 27 lakh 16,220 minus 10 lakhs will give you 17 lakh. So this is the second option. Again, you are upgrading the machine, you are not selling the existing machine, and hence you don't receive the initial 50,000. The third option is you are replacing, that is replace the old machine, in which case you are going to spend 20 lakh plus 50,000, 20 lakh 50 today, on which you will get 20 lakh 50 divided by 5, that is 4 lakh 10,000 of depreciation. So if I have to calculate the cash flow, every year I have to add back 4 lakh 10,000 of depreciation to find the cash flow. However, I will get the salvage value of 50,000. Now 50,000 will be my cash inflow. So technically, initially, I will say I'll spend 20 lakh 50 cash outflow and I'll receive 50,000. However, there's a tax rate given in the question, which means there'll be capital gains. That is, selling proceeds is 50,000, cost is 0, and hence 50,000 is the capital gains into the tax rate of 40%, and hence 20,000 will be your capital gains, which you will also have to pay tax initially, capital gains tax. And hence if you look at the third option, initial investment 20 lakh 50, sale proceeds initially is 50,000, but the important hidden adjustment is tax on the sale of the machine is 20,000, and as a result over here this will give you your tax on the sale proceeds as well. Apart from that, you will add back depreciation, find the cash inflow at 36 lakh minus your cash outflow of 20 lakh 50 50,000 of cash inflow and 20,000 of tax. All said and done, you get 16 lakh 35,450. Whichever option gives you the highest NPV, that is continuing the existing machine, is the option you try to select. Okay, so this kind of takes care of question number 5. They have done this using incremental analysis, which is a little confusing. I would prefer to solve each of these options separately, which makes it a lot more easier and manageable. Okay, and then you have this last question, but before that we'll discuss the other concepts which are there. Achha, this point B is to kind of discuss the other replacement possibility, where you are having an existing machine, you are replacing it by a new machine which is different, and you are wondering when to replace the existing machine, in which case you will try to find the cash flows over a standard life, let's say 4 years, 3 years, and whichever option gives you the lowest cash outflow is what you select. Ideally, you could have even done optimum replacement time by doing a divide by PVF, but sometimes institute has done a bit of inconsistency in a couple of problems. Achha, then we have utility analysis. Utility analysis has come in one of the recent November 24 or so RTPs, but not made it to the main exam. This is for an investor who values utility. Now, generally we believe investors are rational, and rational investors would say whichever project gives me the highest NPV is the project I should select. Now, let's say there are 2 projects. One is a project which is a very glamorous project, like buying an airline. Another project is like collecting waste. A rational investment thesis would say whichever project gives you the highest NPV, whether it is garbage collection, you should select that. However, maybe owning an airline or a club or restaurant is a lot more glamorous than, for example, running a waste collection business. So you might assign utilities. How will I know, sir, in the exam whether I have to use utilities? Then utilities will be given to you. If utilities are given to you and assessment is done based on utilities, then you will try to find the expected utility of your project. Whichever project gives you the higher expected utility will be selected. We will do this only if the question specifically requires us and gives us utilities, otherwise this is not done. If utility factors are given, selection of project will be based on project which gives you the highest utility and not necessarily based on traditional NPV. Then there's a decision tree analysis where you might have different possibilities, and based on that you have to come to a conclusion, in which case you might have to make a chart. Sometimes decision tree questions come as dependent cash flows, that is in year 1, let's say cash flows can be 50,000 or 60,000. If it is 50, then in year 2 this can be 70, 80, 90. If it was 60, then it can be 90, 1 lakh, whatever. You can build a tree and do the evaluation. However, there can be multiple decisions to be taken. In that case, you have to make a flowchart type of a thing and conclude like a consultant and say that if this thing happens, then what should be your outcome? If this happens, what should be your outcome? So you can try to make a chart where there are multiple decision areas. Like usually in questions, you have only one decision area. If NPV is positive, accept the project, NPV is negative, reject the project. However, the question that we will do, which is there in your material, there are multiple points to decide, in which case at every decision point, you have to calculate, evaluate and comment on what should be the appropriate decision. So we will diagrammatically plot various paths and evaluate based on the respective paths. And then there is simulation on this. There is no detailed sum in the institute material. There is an example, but simulation is nothing but trial and error. That is, you will have a data set. In that data set, there may be certain important factors like, for example, cash flow, or for example, project life. So what you will try to do is, you will try to simulate various possibilities, random, and try to find NPVs at different possibilities. So there is a process. You assign random numbers based on probabilities. I'm not doing too much detailing here. Assign random numbers based on probabilities, and at every loop try to find what will be, let's say, the project cash flow, or what will be the life, or any factor, and try to find NPVs. Practically people use simulation. There are lakhs of different, lakhs, not thousands or hundreds of different simulations or possibilities which are run. But again, this is a method which is more of a statistical and a computer software driven method rather than a student driven, where you sit and manually calculate. But if it comes, you should be aware. Okay, for decision tree, there is one question, I guess that kind of takes the essence of this chapter by and large. if you need, again as I said, if you need to do more detailed revisions for a particular question or a concept, there is a good 6.5 hour video which is on YouTube only. You can refer each and every question in detail which is discussed and solved there. So this is 7. L&R wishes to develop a new virus cleaner software. The cost of the pilot project would be 2,40,000. So the first decision is, should you take the pilot project or not? If you take it, then 2,40,000 will be spent. Otherwise, you don't take the pilot project, in which case nothing will be spent. Presently, the chances of the project being successfully launched on a commercial scale are 50%. Now, you can do pilot project. After that, you come to, let us say, you get some learnings, and then you decide to commercially launch after the pilot project. However, commercial launch may be a success, may be a failure. The chances of success are 50%, which means the chances of failure are also 50%. In case it does succeed, L&R can invest a sum of 20 lakhs to market the product. Now, you have done the pilot project, you have commercially launched the product, and now you see it's a success. In which case, you can invest a further 20 lakhs to market the product. Such an effort can generate to perpetuity an annual net tax cash income of 4 lakhs. This is 4 lakhs of cash income per annum up to perpetuity. Now, any cash flow up to perpetuity, if you want to find the present value, you can use a Gordon's formula. That is, let's say cash flow 1 upon the discount factor minus G. Okay, so this is 4. Even if the commercial launch fails, they can make an investment of a smaller amount, say 12 lakhs, with the hope of gaining in perpetuity a sum of 1 lakh. Evaluate the proposal adopting a decision tree approach where the discount rate is 10%. Achha, if I were to invest after the commercial launch, in case of success, maybe I will get, let's say there's no growth rate, I'll get 40 lakhs of cash inflow. And if there's a failure, I were to invest 12 lakhs, I'll get 1 lakh in each year, divided by 0.1 minus G will be 10 lakhs. So if I look at my decision tree, in my decision tree, I will first figure out whether I should test, in which case I'll spend 2,40,000, or not test at all. Once I test and later I commercially launch, there's a success possibility of 50%, failure possibility of 50%, I cannot control that. But if there is a success, then there are two choices. I can either invest, okay, if there's a success, I can invest 20 lakhs, in return I'll get present value of cash inflows worth 40 lakhs and hence an NPV of 20. Achha, iska probability kya hai? 50% chance. If there's a failure and if I decide to invest, then I will invest 12 lakhs, but in return I will get present value of 10 rupees. So there's a -2, which is a 0.5 chance. So the thing is, if there is a success, then it is worthwhile to invest a further 20 lakhs because it is favorable. However, if there's a failure, why should I invest further and lose more money? In which case, I can always say that it makes sense making no investment. It's not forced that you have to make an investment later. In which case, let us say this will be 0. And if this will be 0, well, there's a 0 NPV. It's better than a -2 NPV. So over here, if you go to C, at point C, if there's a success, I can invest 20 lakhs and generate income of 4 lakhs to perpetuity, which is what you should do. Or no invest. No. At this point, as a consultant, if someone asks you that if I reach point C, then I will say go ahead and invest 20 lakhs. But if I reach point D, then as a consultant, I will say that it is not worth investing 12 lakhs to get 1 lakh. Rather, you make no such investment. So this will be a good decision tree where I will invest 20 lakhs if there's a success, and I will not do anything further if there's a failure. But should I go ahead and do the pilot project in the first place or not? Well, is it worth? Is the launch giving me as much return? Well, if the launch is giving me 20 with a 50% probability and 0 with a 50% probability, which means the expected NPV is around 10. 20 into 0.5 plus 0 into 0.5, that is 10. Now, for getting this average 10, I'll have to do the pilot project. Now, this pilot project is worth 2,40,000. So, is it worth doing the pilot project? Yes. Achha, because that is just 2,40,000 and which can possibly give us an average cash flow of close to 10 lakhs and hence it is worth doing. So, your decision point at A would be, should you test? The answer is yes, because if you spend 2,40,000, there's a possibility you do a launch and there's a success or there's a failure. On an average, that will make 10 lakhs of NPV on a 2,40,000 of pilot project cost, so it is worth doing. On the other hand, if the pilot project cost hypothetically was, let's say, 24 lakhs, then I would have said it is not worth doing a test of 24 lakhs and then landing up with something which has an average NPV of 10 lakhs. Usse acha test hi na kare and do no testing. But this is not the case over here. So the decision points over here would be, should I do the pilot test? Yes. After I do the pilot test, then with learnings, once I do a commercial launch, only then will I know if it's a success or a failure. If it's a success, you go ahead and do further investment. If it's a failure, you avoid and do no further investment. Perfect. So I guess that should be it. That should take care of your capital budgeting, advanced capital budgeting quick revision. I hope that this video has been helpful for you, and this chapter is something that's a scoring chapter. Do really well. We'll come further with more such revision videos. If you kind of like the content that we are giving, please ensure that you press the subscribe button and like the video as well. It means a lot for us. So you'll also get updates when we update new videos. So keep studying, keep pushing hard, and I'll see you soon with more such videos. Good luck, goodbye, and keep studying. Take care.